Hey, everybody. Good to be here. Time for managing an options portfolio. And, sometimes managing an options portfolio and managing existing trades, partially, you need the full information, and that is looking back at past trades and figuring out how things stand in your portfolio. We're going to hit that up next. Glad you're here. And familiar names in the chat, and some of you are watching on a recording. Grateful for you too. I'm joined by Ben Watson, for those of you who are live. And so, I've been working with Ben a lot of years, over 2 decades now, and he's very knowledgeable on what I'm going through here today. And so between Ben and myself, we'll do our best to get your questions answered. And if you ever have a workshop in your area, Ben is probably the main guy there. So make sure you check out Ben. He's kind of the face of Schwab in a sense in our live workshops going around the country, and they're always great events. You can follow us on X as well, at Brentmore CS, at Ben Watson CS, for additional content throughout the week pertaining to financial markets. Now, before we get into the subject at hand, let me remind you a few things. One, options do carry a high level of risk and are not suitable for all investors, and multiple leg option strategies will involve multiple transaction costs. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount, and the material today is intended for general informational purposes only. It's not an individual recommendation or personalized investment advice. The paper money software application is provided for educational purposes only. And for the sake of simplicity, we may not factor in commissions in these trades that we look at, but keep in mind that they're a real thing that you need to consider. All investing involves risk, including the loss of principal. And Schwab does not recommend the use of technical analysis as the sole means of investment research. Okay, let's head on over to the Thinkorswim platform, because what I want to do is I want to talk to you about some features on Thinkorswim to go back and look and see how you're doing. Because, sometimes we're looking at things like, the activity and positions page, which is very normal. Looking at the position statement, and you can look at your PL open. Sometimes that doesn't tell the whole story, and certainly it doesn't tell the whole story of past trades. So one area that you are going to want to be familiar with is the account statement section. And in the account statement section, a couple things just off the bat that throws people off. One, double check how many days your look back period is on that. I have 300 days right now on that, but you can change that to whatever. Sometimes it'll be like 1 day back and you're looking for something and you're not seeing it. Well, that may be why. How far are we looking back? Number two, if you have a symbol up here, let's say we had a symbol F for forward in there, you're not going to see anything on, say, order history or trade history that's not forward. That can be very useful if you have a lot of trades and you want to identify and look at a particular symbol. But if you're not looking for intentionally for that particular symbol, you're not going to see the trades you probably want to see. But beyond that, and we're going to get to the order history and trade history shortly, but let me just mention a couple things. There's a profit and losses section. And what you can do is you can look at particular stocks, whether you own them now or not, whether you have an existing trade on them or not, and see what's your profit or loss on that here over the past year or particular time frame that you're looking at. Let me give you an example. Which ones do I have a position on right now? Well, the ones I have a position on right now are the ones that have a PL open value on it. Those that have 0 on that are ones that I don't currently have a position on right now. And you can see that expressed in a percentage terms as well. PL year to date. PL year to date is going from January 1st to now. What's our profit or loss for any position that we've had from January 1st until now? PL difference. What's that? That's kind of a weird one. PL difference. That's looking at the time period here, the time period. Profit or loss during the time period. Margin requirement, mark value. So that's profits and losses. Now, I'll be honest. There's a couple of these things that I don't use that often. I don't look at this that often here on the profits and losses, but you may find that valuable for some particular reason. Another page that I don't use that often, but you should be familiar with because maybe you'll find it valuable, is this options page. Now, we could do equities too, but this is an options webcast we're doing right now, so I'm not going to get into the equities one. But again, look at my existing options positions. These are only positions that are open right now. Now, some of these are spreads. Look, I have Schlumberger here, four different contracts going right now, and that's like an iron condor. Well, I can see those laid out right there. I'm not going to go through this, and I don't use it that often, but there may be some circumstance where you come upon it and you want to see what option contracts do I want right now listed out all right in front of me. And there you go. Okay. And you can see your trade price, mark value, and so on. Probably more commonly, though, is we're going to use order history and trade history. Order history can be valuable because it's going to show you the orders you've placed regardless of whether they have been filled or not. Some of these, you can see the status column over here. Let me see if I can make that a little bigger. You can see the status column and you can see whether they are filled or not. But sometimes they're canceled. What's this? We can go, why was this canceled? Well, I can look back and I don't even remember this. This was just a few days ago. But on this, what I can see is I had an order to enter a trade on Uber, and I can see the date on this, Halloween, 12/41, and then 45 seconds later, so I canceled this order, and then I did another one. So clearly, in hindsight, I can see, oh, I did this, it wasn't filling, so I changed the price on it to a different price. This one was a 90-cent limit. This is a 97-cent limit, and I filled it at a little higher limit price. So I can reconstruct what happened on different things. Let's look at another one. Let me get out of this and scroll down here just a little bit. Sometimes you may see, hold on one sec. Yeah, right here, expired. What's expired? That's just an options, a trade. So this is an order, it's not a trade, an order. This is an order that expired. I had a order placed on a long, you can see +1, call on General Motors, and it just went away. So is this going to show on my trade history? No. Okay. No, it won't show on my trade history because this was an order that wasn't traded. It expired. There's going to be times when you want order history and times when you want to look at trade history. What about if you just change a stop on a stock? You move a stop up on a stock. Are you going to see that? Yeah, on order history you will. Not trade history though, if you just change a stop. Now, question in the chat. Momo, how do you find the total instrument over the course of a period, say 2 weeks? Well, we can see that. Or another question, how do I only see today's trades? Remember, right now I have 300 days back from today. Let's say I want to go back just to today. I can go to 1 day back, okay? Or you don't want to, you want more than today's trades. I want to go 2 weeks. Am I limited to 1, 7, or 30? No, you can type in whatever you want. I mean, there's a limit. I think you can go back 300, well, there you go, 370 days, okay? 14 days, and I only want to look at Uber trades. So I put in 14 days, and I type in Uber. And now I only see all the trades I've done on Uber over the last 14 days. All the orders, I should say, orders, not the trades. Well, let's see the trades. Do you see the difference there? This one was canceled, so it's not showing up on my trade history. All right. Now, let's say I go away and I come back in a week. Am I going to remember that I had Uber up there and not? And I'm looking, well, where's that trade I did on Ford or whatever? Well, you're not going to see it. I got to clear that out. And maybe I want more than 14 days. Let's do, I don't know, 150 days. Okay. And now I'm going to see a whole bunch of trades there. Now, another way to do it, if you just want to look at a particular symbol, is you can sort these. These columns are sortable there as well. Now let's go to trade history. Okay. So the first thing I want to just point out to you is there's a difference between order history and trade history, and sometimes there's some overlap between the two. But if the order actually isn't filled, you're not going to see it under your trade history. Okay. Here's trade history. Well, let's do this. There's going to be times where you want to see the trades you did. Let me go here, and I want to go, and I'm going to look at Caterpillar. Okay. Here's Caterpillar. So Caterpillar, I have a trade. This is a leaps, but I know this isn't the whole story. I know we rolled this out because one of the trade management principles that we often use on long calls or long puts for that matter, that are more than just like short-term trades, and this is a leaps, it's a longer-term trade. I have a leaps put on Oracle, I have a leaps call on Caterpillar, is when we get to about an 85 delta on these, kind of just the way we're doing it in this webcast is we're rolling them out. Oracle, I just entered not too long ago. Okay, so that we haven't rolled that. But Caterpillar, I'm pretty sure we rolled out at some point. So let's go back and retrace our steps, because remember, your PL open, and I tried to talk about this, I think last week, but we're going to go into it more depth today. Your PL open can maybe not be indicative of everything. And we're going to look at a Costco trade where the PL open is, I got some questions on this after the webcast of this isn't making sense. So we're going to hit it up today in a little more depth looking at Costco. But I thought I'd start with maybe a more simple scenario to start. Here's so I'm going to put in Caterpillar just to kind of narrow down what we're looking at. Caterpillar. And the way to do it is this. Have your time frame, have your symbol, and go by the date. What's my oldest date? And just work your way back on September 23rd. Actually, let me go back further in time here. I'm going to go back to 300 days here, because I think maybe we're missing something here. Okay. I want to do the initial leaps, which is right here, back in May 27th. That's the first time we're dealing with this January 27 contract, that leaps contract. What did we do? Well, we bought it, okay? Green contract +1, we bought for $69.90, okay? Then look at the next thing. What happened to that contract? Well, that 330 contract we sold right here. Do you see that? We bought it here. It's in green, +1. We took that same contract, just look at the parameters on the contract, and we sold it at that point for $163. Then we rolled. We changed that 330 call to a 450 call. That cost us, why say cost? Because it was a purchase contract. That cost us $80. The net on that roll was $83, 84 bucks. Okay, so that's a credit that we brought in at that point. But keep in mind, the second we do this, the PL open zeroes out. Okay, the PL open zeroes out. So the PL open, as much as we use this here in our trades, and we look at this all the time, PL open, it doesn't tell the whole story all the time. You need to be able to recover the history of your trades in order to get the full story of how things are going. I know, trading in the markets is a lot of things. There's a lot of different facets to it. It's not just trying to time entries and time exits, right? You need to be able to go back and view your stuff. By the way, there's a survey link in the chat. We always appreciate your feedback in the survey, including, things you have want to see covered in the class. Now, obviously, there's parameters on that. I can't go into futures in the class or some, this has to pertain to our topic here, but I'll try and cover those in general. Let's go to, let me go to another one here. And this is going to be under our calendars section here. Here's Nike. So Nike, let's recover this history because, things look pretty bleak on this. It's showing we're down $1,300. And to be sure, I think we're down on this, but I think we're going to get a better view once we get the full history of this. So let me go to my account statement. We're going to go to Nike. And remember what we do. Now, this one, it doesn't go back that long. Right now, we're talking like this 74 call. Let me just refresh myself here. What do we got? We got a 74 and a 50 call. Let's see what we got. Let's go back to where we can see those. I'm looking for that 74 call or 50. Oh, there's a 50 call. Okay. I think that's the first instance of this. Let me just go back and make sure. This is the first instance of that 50 call. So how do we do it? What we do is we reconstruct it. Go to the first instance. Remember, the dates are over here on the left. And here was our first date, July 23rd. We did a diagonal spread. Different strikes, different expiration dates. That was a diagonal spread. It cost us $28.50 to start. And then what did we do? We closed out. Hold on one sec. 81. We closed out that 81 call and we bought a new 81 call. We rolled it. You see the dates here? We changed it from August 22nd to September 19th. Now there's transaction costs in here I'm not going to refer to today right now, but keep in mind. So this isn't all in one line. This was in two different order tickets. And so the net credit on that was we brought in about $82. Okay? $82 there. Then what did we do? We rolled it again. We took that 81 call. We bought it back right here to close, and we sold it. And this one, it's in one order ticket, so we could see it right there. That was a 156 credit, okay? And then we did the same thing right there. That 80 call, we went to a 74 call. 85 credit, okay? 85 credit. And then what did we do? We rolled it again. 52 credit. All right. So we could add these up, and these were all nice little credits. Now, these do not make up for the overall loss that we have on the trade, but the point is the PL Open isn't going to recover everything. All right, isn't going to tell us the full story here. Now, I want to go to one that we did that was really confusing to people, and that's this Costco one. And I want to kind of show how to reconstruct this, because Costco right now looks like a disastrous trade, right? Well, it may not be quite as disastrous as it looks. This is a calendar spread, November, December, but I've rolled it. And let's see, let's go back here to Costco. And I'm going to just to try and help visualize things here, I want to show you it seems simple. Only two trades, right? Only two trades. Let's look at our standing here on this though. Okay, we initially, first trade right here, we bought, and we have two contracts on these, but to make it simpler, I'm not even going to deal with the two contract thing. I'm just going to deal with one contract right now. We bought for $40. Okay, you see that? So this was on 10/17, and it was $40 even. Okay. And then, and we bought. So I'm going to call that debit. Okay, we bought that. Let's look at the next one. We sold, same date, for $23. That's a credit. The whole transaction together summed there, but you can't just look at the net price. Look, because you'll see in just a little bit. So we sold for 23. Okay. So the date was the same date. Let's go to 10/17. And we sold for 23. And that was a credit. We brought that in. Credit. Okay, let's go to the next one. This one is when we rolled it, what happened? We closed the long position. So that means we bought, we closed the short position, we bought for 765 on the 29th. Okay. So on the 29th, 10/29, we bought for what did we say, 65? And that was a debit. We paid that. Okay, we got one more here. All right. We sold this position on the same date for 12/05. Okay. So, same date. We sold for 12/05. And that was a credit. Now, that doesn't tell the whole story yet either, because we now have a new position that we could get out of if we wanted to at this point. Let's look at the existing position. Okay, so today, and this is not a realized gain, but if we wanted to, what we could do is we could sell the long position for, what's our mark on that? 36.22. Okay. We could sell the long position if we wanted to. It's an unrealized gain, but let's see, what do we say? 36.35. Okay. 36.35. 36.35. And I'm going to call that a credit because we'd be selling it. And I'm just going to put unrealized here at this point, because there's no guarantee that's the price we'd get out at. Okay. And there's one other trade we could do today. Okay. There's one other trade we could do today. We could get out of our short position. Now that would be a debit to buy it back for $22.50. Okay. For $22.50. So let me do this. And then when we're going to sum, we're going to just do a little bit of math. $22.50. And that is going to be a debit because that would cost us. Again, that's unrealized. I'm not going to write it out. Okay. Now, let's sum our debits and our credits here. Debit 40 plus debit 7.65 plus debit of 22.50 equals, that's $70.15. Let's do the same thing for credits. 23 plus 12.05 plus 22.50 is, did I do this right? 57.55. I did this wrong somehow. What did I do wrong? One sec here. What did I do wrong? One quick sec. I am closing this out. I'm selling this for 36. Yes. I'm buying this for 22. That's correct. Let me go back to my account statement. I think I did something wrong here. I sold up front for 23. I bought for 40. Yes, Excel would probably be the better way to go. Josh is pointing out on that. I bought for 765, and let's see, that was to close, and I sold for 1205. I added 22 instead of 36 for the credits. Okay, let me do this one more time. Let's do that math one more time. Okay, 22.50 plus 12.05 plus 23 is equal to 57. I don't know. I added 22 instead of, oh, I say credit there. That's what I don't know why that was not supposed to be in there. Okay, let's try this again. 36, that was where my problem was. It added that extra, or I blame it. I guess I added that extra credit line there. 36.35 credit plus 12.05 credit plus 23 credit is 71.40 credit. Let's do the debits. 7.65 plus 40 plus 22.50 for debits. 70.15. There we go. Thank you very much. I don't know how to say the handle there on that, so I won't say that. But you see what the net result is? We ended up with 71.40 in unrealized credits on this. We ended up with 70.15, and it's a moving target, of course, in unrealized debits on this. So actually, overall, it's going okay. Sometimes you need to go back and reconstruct history. Now, as Josh said in the chat, Josh said, well, you could put it in a spreadsheet and have it added up. Yes, that would have been better. But this kind of goes through how you do that to reconstruct the trade. The problem is this. Let me get this out of the way. When you look at this, you can't tell, at least I can't tell. My brain is not good enough to tell just looking at like net prices here on this and then going here and figuring out what we got here on this trade to see what the true picture of the trade is there. Okay, so I want to go on and look at some management of trades though. Let's do that. Let's find some management of trades and do it that way. Any questions on that? If you can do your basic summing arithmetic, it goes a little bit smoother than what I just did there. But let's look at some trades here. Last week, we did not do any short vertical trades. We didn't look at any, so I'd like to make sure we address some of those today. First one, I'm not going to go through everything because I don't have time to go through everything here, but I want to go through a bunch and give you a variety. Number one, here is, let me get rid of that. Here is Cisco. How many days do I have to expiration? 2 days. It doesn't matter whether this thing is good, bad, or ugly. With 2 days to go to expiration, in this class, we're getting out of our short verticals, getting out of most of our trades at that point, in any case. So it's looking okay, but with 2 days to go to expiration, we're just going to exit that trade and get out of it. So if I want to get out of that trade, I can just highlight it. I can right-click on it, create a closing order, and I'm going to buy it back, okay? I'm going to put that order in to buy that back, and I'm going to confirm and send, and I'm going to send that, and it's thinking we'll let that work here for us, okay? So let's go to the next one. I want to go to Datadog. I've got 16 days to go to expiration. Remember, usually less than a week or so, we're looking to get out of this. Are things going okay or not? Those things are going fairly well on this trade. This is a short put vertical. We're bullish on it. The stock's at 155. Our short put's about 140. What do we want on the trade? We want the stock to be above the short put strike. It is. That's great. we're going to get out if there's a technical breakdown, if we're bearish on this. Given that the stock's at 155 and our short put's at 140, it seems unlikely we have much of a technical breakdown on it, but I suppose it's possible. So if it's looking bearish, no, I wouldn't say it's looking bearish. We could go. Now, we have earnings. Do we want to hold this through earnings? Let me tell you one thing about how earnings is going to affect this trade is even if things are going well, if you have earnings because of implied volatilities, which are pretty high here, okay, after earnings, these are likely to go down. Not the stock, the implied volatilities are likely to go down. So Fran Green said, can you tell me why I overpay for calls and puts? Well, this is, maybe it's an implied volatility thing is the only thing I can say. I don't know, but this is a measure of implied volatility, but it's the same thing as it's a measure of options prices. This is how expensive option prices are. And so if we don't have that, if implied volatilities are very high, the option which we want to go down in value, right? The option which we want to go down in value is not going to go down as much in value. Yeah, that's that implied volatility crush we've talked about. So we're not going to make money as quickly as we can on this. And so it's still going to hold on to that value. So Fran Green says, Paul said, why not have a PL? Well, yeah, we can add that PL percentage. I often have it. I think I was tweaking things around, and you can certainly add that PL percent on that if you want. And you can look here on this, and 53%. Just be aware, sometimes that can be a little bit, sometimes it can be kind of, I don't know. If you have more than like a vertical on there, sometimes it can be kind of confusing with the PL percent. But yeah, so we've made good money on it. The question really is going to come down to, am I willing to hold it through earnings? If earnings were not there, what I would probably say is, for our purposes, let's just let it run because we're still bullish or at least neutral on it. And there's still a fair amount more value. We've only made, half of what we can make on this. So we'd stick with that. All right. But because of earnings, I'm going to go out and I'm going to exit this out. So I'm going to close this out. I'm going to click on critical. We're going to buy that back and see if we can get filled at a little bit of a higher price. The spreads are a little bit bigger on that, but we're out of Datadog. Okay. So let's go to the next one. The next one is maybe a little bit more complicated here. This is an iron condor. Okay, this is an iron condor. So we have NVIDIA. We've got about a week to go. So regardless, we're probably going to close out, but let's kind of look at it as if we weren't going to close out just because there's a week to go. Okay, there's about under 10 days to go. Exit the trade is how we're going to normally do it. So I'm going to exit this, but before we do so, let's say instead of 9 days to go to expiration, let's say we had 15 or 20 days to go to expiration. Would we get out? Remember, we're going to is an iron condor. There's two separate verticals here that we're going to look at. Two separate verticals. So on the put side of things, where's the stock? The stock's at 201, well above my put strike. So this has probably made pretty much everything it can make on this, right? There's just not that much value left on it. There's only about 13 cents left in the price, in the spread there, okay? And so we've made over 80% of what we can make. So we're going to get out. We're going to manage the winners. We would exit that. Regardless of whether we have 9 days or 20 days, we would be exiting the put spread on that. Okay? Hope that makes sense. Hope that makes sense. Okay. Now let's look at the calls. That's a little bit more of a tricky situation because things aren't going so hot on the calls. Here we go. These are the call vertical. We're managing separate. 205, 210. The stock has gone up. It's not going so great. We're losing money on this. Okay, combine those two together. We're losing money on that. Or you can kind of look at your PL percentages and see, well, my loss is bigger than my gain. So the question then becomes this. Has this completely gone bullish on me? And if it has, I'll probably just exit. Or do I think this is going to stay below our 205 strike? Then I may decide to stick with it. This is, of course, assuming we had more time on this. Well, let's look at the trade. Let's look at NVIDIA. So here is NVIDIA. Here's NVIDIA, and we got earnings, but that's past our expiration here on this. I could see sticking with that if we didn't have the expiration coming up on this and giving it some more time. Right now, and this may be a factor, time decay is on our side, even on just the put contract. There's about 11 points of theta here on this. Time is helping us out. In this case, though, we're just going to get out. It's time we're under 10 days. We're going to look to get out of these. Now, what am I going to do? I'm going to get out of them separately. First of all, before I get out, I'm going to cancel my stop order on this. I'm just going to cancel that stop so that I don't have to deal with that anymore. I'm going to get rid of my calls, right click, closing order, buy the call vertical back. I'm going to go back here. I'm going to click here, and I'm going to buy the put vertical back. And send. Okay. All right. So, and that's, I'm not going to take that. We could tweak the price if we wanted to on the calls and get out. I'll do that. I don't want to take the time on that right now because we're going to run out of time otherwise. I may go back to some others here, but I don't want to run out of time because I want to follow up on some trades that we did in the condors, calendars, and butterflies class on last Friday. We did calendars on earnings, and we did a couple earnings calendars trades here, and I want to talk about the management of those. Sorry, this is scrunched way down. Let's pull this up. We had Pfizer and Uber. Okay, Pfizer and Uber, we did earnings calendars on. So you can see, we're not like getting rich here or anything on Pfizer, but what's the management of these? Well, first of all, of course, on a normal calendar, forget the whole earnings calendar thing. Once we get under 10 days to go to expiration, we're going to look to get out of the short position. Maybe roll it, maybe not. But in the case of this, we're going to get out after earnings. We had earnings. Earnings was yesterday morning on Pfizer. And the stock more or less cooperated. And we made a little bit. And, in theory, going back to the whole notion of implied volatility, let me pull up Pfizer. Implied volatility drops after earnings, okay? Drops there. And that's really the premise of the trade here on this. This was just a very short, this was like a 3 market day trade. So it didn't really give us much time, but it worked out. And so I'm going to look to get out. I'm going to cancel out of these. Remember, short options can be assigned anytime up to expiration. We're in the money here, which would probably increase the odds of expiration. As we get closer to expiration, that's going to increase the odds of assignment there. So first, what I'm going to do is I'm going to cancel I have a stop on it. I'm going to cancel that order. And I'm going to just get rid of the whole thing. Could I roll it? I could roll it. Probably not for our purposes in this class. And the reason is this. This trade was solely done for the earnings calendar. Okay. I could, if it were just kind of a normal run-of-the-mill calendar, I may consider rolling that November 7th contract out to November 14th contract. That would be a possibility. But this was done explicitly for a calendar, for earnings. So we're going to get out. Okay. So we're going to delete. Not delete, we're going to close it out, sell that out. And by the way, when you enter a spread trade on Thinkorswim, the default is to the mid price. It can be difficult to get filled at the mid price. I'm going to move that down just a little bit to try and increase the odds of getting filled on that. I'm going to send that trade, and it's thinking, still hasn't filled. We could always do that later. We had a similar order, similar trade on Uber. Again, it was an earnings calendar. Again, on Uber, we had earnings yesterday morning. I think it was yesterday morning. And you can see that implied volatility drop, which is probably the biggest reason we're up on the trade, about 40 bucks or so. So again, we're going to get out of this. I don't actually have a stop on this one right now. So I'm going to look to get out of this. I'm going to right click on it. I'm going to create that closing order. I'm going to sell this. I'm going to move it off the mid price to try and get filled between the mid and natural price. Send that, and that one has filled. Okay. All right. Now, I'm just about out of time here. Let me just finish up one last trade. Perhaps we'll look at. We'll give you a different type of trade. Let's look at a long vertical trade. We've got Abbott Labs. Okay, it's a long put vertical. Move this down. It's a long put vertical. The stock's just a little bit below 125. We want the stock to be below 125. On a long put vertical, we want it to be below the short strike, but there's still going to be a fair amount of time value left on this. It doesn't look like there's earnings very soon on this, or else we would have those other symbols. In other words, if I do, one sec, if I look at these contracts, you see this? That's a sign that earnings is coming up. With that the blue circle, red phone, that's a sign earnings is coming up. Okay, so things are going fairly well. You can see our PL Open's going okay. But when would we get out? Well, we'll get out. Maybe we have a price target on this. And this is going to something I think Paul said earlier. Sometimes you may put a target price on there and say, well, if I've made half of what I've made on that. Well, we've almost made half of what we made. We haven't exactly made half of what we can make, or half of what there is on this. There's still some value on this. Remember, at expiration, there could be a $5 difference between these contracts. Right now, there's about a $3 difference between those contracts. And so there we go. We're gonna get out of that. So excuse me, we're gonna stick with that. We're gonna let that run here for a little bit there. And there we go. Okay. So what did we talk about today, everybody? We talked about recovering data for past trades. Maybe they're an existing trade too. We talked about looking trade history. We talked about using the options, the profits and losses, order history, and using trade history to try and kind of reconstruct the trade there. And sometimes, usually you don't have to do that. Usually it doesn't have to be as complicated as what we did on that Costco example. But every once in a while, if you get in a bind and you can't figure it out, like I couldn't figure it out just looking at Costco, what I had to do was I had to just kind of write it out. Now, you don't have to do it. I'm demonstrating to you so that you can see it a little easier. But you just got to add them up, and that can help you a little bit too on that to recover that. And then we talked about the management of short verticals, including iron condors, long verticals, earnings calendars here today. Appreciate y'all. Coming up next, we have trading price patterns. Make sure you follow Ben and myself on X at Ben Watson CS, at Brent Moores CS. Thank you, Ben, for helping me out in the chat. Thank you. Good questions in the chat there, everybody. And we'll see you all same time next week. Bye-bye, everybody.